Okay. Hi, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago. Talking crude futures. The May crude oil futures finished up marginally, about 52 cents or so at 51.67. Now, at this point, you've heard enough about the data from EIA yesterday and how we had a build that was a little bit bigger than the small draw that people expected out of the EIA, as well as the gasoline build, which was also expected to be a light draw. I'm sorry, the gasoline draw, which is expected to be a larger draw than it was. So this ends the streak of 3 weeks of multi-million barrel draws on the gasoline inventories, and the crude inventories didn't draw at all. But what was more important in that data was the refinery runs, and that's why we still had a small bid to crude oil today. The data showed that the refineries are starting to ramp up for the summer driving season, and when they ramp up, they're really underproducing right now. That's what refinery runs are. Talk about the amount of product that's actually running out of the refineries, or production that's being made into gasoline, jet fuel, distillates, diesel, etc. The refineries are ramping up now for the summer driving season and the increase in summer demand. So there's an expectation that you're going to start to see very large crude oil draws. Now again, we're still about 32 million barrels over where we were at this time last year. So you really need to see a ramp up in demand to get what OPEC wants. But speaking of OPEC, we have some OPEC optimism in terms of extending the agreement. They meet again May 25th to talk about extending and possibly even cutting more from their production to try and take advantage of this ramp up that we've had now in prices since we made those lows at about $47 or so. That's the time for OPEC to do it if they want to have an effect. They don't want to be cutting production into a market that's falling. They want to be cutting production into a market that's rising to get that sort of momentum effect to push prices where they want them to go, especially prior to the Saudi Aramco IPO that's going to be happening on the New York Stock Exchange. Now that's possible, but you have to keep in mind that U.S. production is still the key. U.S. production reached a 14-month high, 9.2 million barrels a day now. So this is definitely the time for OPEC to either cut more or announce an extension of that of the production cut agreement. We've only got May and June left for them to do it. They're probably not going to do it at the end of June, so the May 25th meeting would be the time to do it. And again, 14-month high in U.S. production, 9.2 million barrels, and not really slowing down. We're seeing expansion of rig counts again. However, definitely the higher producing rigs were the ones that were going to come online first. So this isn't necessarily an exponential increase of production. So now we stop looking so much at rig count increases and start looking more at the production increases that we see in the EIA numbers. This is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago.